Hello, I'm Carla Jones, Chief Financial and Administrative Officer at the Community Foundation. I have with me our investment consultant, Elizabeth Monticelli with Mercer. Thanks for joining us today.
Great, thanks, Carla. Glad to be here.
We just finished up our quarterly investment committee meeting and thought we would take a few minutes to talk about some of the things that the investment committee discussed today. As we always do, we have a lot on the agenda, and our investment committee really dives deep into various topics. We have been taking each meeting this year as a different educational opportunity. And at this meeting, we talked about interest rates because it seemed like a very timely topic considering how the last year has gone. One of the things that we did do this year at this meeting is we took an in-depth look at our investment policy statement, which we do every year. And the committee is kind of diving even deeper into a couple of different areas. Concentration is one of those areas.
Right. So we do have a lot of concentration right now in the S&P 500, and there are 7 stocks, tech stocks, that have done very well, and they're called the Magnificent Seven, and they're comprising about 29% of the S&P 500. So the committee's question was, it's our fiduciary responsibility to watch out for risks, and is this a risk that we have to be concerned about? So we went back and looked at the S&P 500 over the last 23 years, and the S&P 500 has always had a heavy concentration. The top 10 stocks usually comprise about 20 to 29%. Today it's a little bit higher than normal, but the committee reviewed all that, discussed it, went back and looked. At one point it was the oil stocks in 2010. But right now they're comfortable with that because the other parts of the portfolio are very diversified and outweigh those concentrated S&P 500 companies.
So as we think about that, I know that, we think about the long-term growth portfolio, which is our actively managed portfolio. We make very strategic tactical allocations within that portfolio. The committee works with Mercer to select investment managers for different asset classes. But the index growth portfolio is a little bit different. Could you maybe talk about kind of the makeup of that and how that follows?
Right. So the index growth portfolio's objective is to invest in passive and low-cost mutual funds or investment funds. And we do that, but we still are able to get diversification. So even though it owns the Vanguard S&P 500 index fund, and it's got that heavy concentration with the Magnificent Seven, you also hold the indexed international, and you also hold U.S. small caps, and you also hold fixed income and multi-asset credit. So it is diversified among regions across the U.S. and the world and sized capitalization. So there is diversification with that inside the index portfolio.
So the long-term growth portfolio and index portfolios are really structured very similarly for the investment makeup, but really from the tactical and strategic allocation, the long-term growth portfolio is where we do that, whereas the index one is much more passive investments and follows the market.
Exactly. So we have, for example, a value manager in the international, and if we want to overweight value, we overweight that active manager and underweight the growth manager. So you're able to do that and do some style tilts within the long-term growth. You don't necessarily see that in the index growth.
Great. The other thing that the committee talked about was looking at the benchmarks that are used for each of those different portfolios. No major changes there, but just making sure that we're always in line in that area.
Right. So we reviewed that, and we went and took a deep dive into the private equity benchmarks, and then we also, if a manager's index has changed, we'll make that change in the investment policy statement, and the committee reviewed that and approved it.
The other thing that your team did was brought an expert to talk to us about interest rates and kind of what the outlook is for interest rates and looking forward to next year. Could you tell us a little more about that?
Yeah, and it's perfect timing because last week everybody knows the Fed just met. So interest rates were paused by the Fed. Our outlook going forward is interest rates will be higher for longer. The Fed will be hesitant to cut again. It'll be very data-driven. Mm-hmm. It all depends on inflation. And the Fed has a target inflation rate right now, and we are a little bit above that, so that there could be one more Fed cut just because that interest rate, the inflation rate's higher than their targeted inflation rate. But we will see maybe late next year. But regardless, at the end of the day, interest rates will be higher for longer.
So what's the impact of that on the portfolio?
Excellent question, Carla. So our expected return forecast on fixed income have improved because those yields are higher. They really fell off a cliff the last couple of years as interest rates rose. But going forward, our return forecasts are higher on the fixed income. For equities, about the same, maybe a little bit lower in U.S. because those Magnificent Seven have done so well, and we don't think they'll continue to do as well. And some of it lately has been more an increase in their pricing rather than earnings improvement. So all of that being said, your portfolios have a mix of stock and bonds. So if the bond forecasts have improved and equities have remained the same, the portfolio with the most in fixed income will have a higher expected return improvement from our previous forecasts, and that would be the moderate growth. The other two portfolios, the long-term growth and index growth, will see slight improvement in their expected return forecast, but not so much as the moderate.
One of the points I found very interesting was when he was talking about this, the fact that stocks and bonds were tightly correlated over the last years. And so he really put an emphasis on owning assets outside of traditional asset classes. And our long-term growth portfolio is really the portfolio where we're able to do that.
Exactly. So you've got multi-asset credit, hedge funds, private equity, and real assets that have provided less correlation and some diversification benefits. But you're right, unfortunately, stocks and bonds have both fallen. So you've needed that outside different diversification away from stocks and bonds to help you out. And that's really benefited the portfolios.
Great. And I think the major theme was stay diversified.
Yes.
And so, our committee will continue to have those conversations as we move forward. We're looking forward to next year and thinking about some new opportunities for our committee to continue to learn in the investment industry and field. We know that in February, we'll have an investment committee meeting, and we'll also have an opportunity for our fund holders to listen to an educational session put on by Mercer. And so we always find that to be very helpful for our fund holders. Our team is always available to you. If you have questions about the Community Foundation's investments, please feel free to reach out to your account manager, and we can get a team together to have a conversation with you about that. Thank you for your partnership with the Community Foundation.